Hi guys, welcome back to the YouTube channel. In this video, we're doing a complete masterclass, the ultimate guide to property investment here in the UK, whether you're doing your own name, limited company, what you need to know about structuring, tax considerations, and everything in between. The starting point for investing in property is getting the right structure. Historically speaking, investing in property through your own name was pretty much the way to go. This was up until around 2016 when the Section 24 was introduced, and it's basically around how you deduct the mortgage interest when it comes to calculating your tax bill. Historically, you could just deduct the full mortgage expense you pay. So when you invest in property, usually you have an interest-only mortgage. You'll deduct the mortgage interest when it comes to calculating your profits, and you would simply pay tax on your profits. If you're a 20% taxpayer, 20% of your net rental profits, deducting everything, that's what you would pay in taxes. 40% if you're a higher rate, 45% if you're an additional rate taxpayer. However, in 2016, things changed. The Section 24 tax restrictions basically mean that you can no longer fully deduct the mortgage interest as an expense. So what you do now when it comes to calculating your tax liability is you can deduct all of your expenses except for mortgage interest. This is bad news for landlords because mortgage interest is pretty much the biggest expense that you pay. And instead, what you get is a 20% tax credit on your mortgage interest amount. So the way it works is if you deduct all of your expenses that are non-mortgage, no finance costs, so all your kind of repairs, maintenance, letting agents fees, anything like that, whatever you're left with at the end, essentially you'll just pay tax on that at your marginal rate. So if you're 20% taxpayer, okay, and then you'll get a 20% tax credit for the amount of mortgage interest that you've paid. So if you're a 20% taxpayer, you're actually no worse off by this change. But if you're a higher rate taxpayer, additional rate, or you claim child benefit, or you're near the personal allowance threshold, this change is disastrous because you end up paying tax at 60% or 45%, whatever it might be, effectively on your rental profits, but you only get a 20% tax deduction for the mortgage interest that you've paid, meaning your tax bill goes up significantly. As a result of this, a lot of people now invest in a limited company, and indeed most of our clients do, simply because you can deduct all of your mortgage interest as an expense when it comes to calculating your profit, and the tax rates are usually slightly lower as well for those invested in property via a limited company. That said, if you are planning to become a smaller buy-to-let landlord and you do only have modest other income, and by this we mean you're comfortably below the basic rate threshold, so about £50,000 in total earnings, plus when you add on your anticipated rental profits as well, then it can still make sense to buy one or two properties in your own name as long as you have no plans of becoming a higher rate taxpayer at some point in the future. If you're earning pretty decent money already, or you do want to grow a large property portfolio, a limited company is pretty much the best way to go. So now you know you want to invest via a limited company. What type of limited company should you be looking at setting up? Because there's quite a few different structures around limited companies themselves. We've got an ordinary limited company. You can set this up at company's house, single class of shares. You might have yourself, your partner as shareholders, directors, whatever it might be. Relatively straightforward. And this is how probably about 99% of companies are actually structured in the UK, just a simple vanilla limited company. But the trouble with these is they're not that tax efficient and they lack flexibility. And this is where you can have a different type of limited company where you can modify the rights that you attach to the shares. You might see this termed around as kind of alphabet shares, Frida shares, growth shares. There's loads of different names for it, but essentially it means modifying the rights of the shares to create some kind of tax advantage usually and give you that flexibility. The way we do this for a lot of our clients is with alphabet shares. So say for instance, you've got a husband and wife, one's a basic rate taxpayer, one's a higher rate taxpayer. If you set up an ordinary limited company, you have to pay dividends in proportion to the shareholders. So say for instance, you're taking out a £10,000 dividend and the company is owned 50-50, husband and wife. The lower rate taxpayer will pay probably 8.75% tax on those dividends. The higher rate taxpayer 33.75%. And because you can't split those dividends in any other proportion, it's not tax efficient. If you've got alphabet shares, you can have different dividends declared on different share classes, and as a result, you might give more to the lower rate taxpayer, less to the higher rate taxpayer, and save income tax that way. And you can also structure the shares to have different capital rights, different voting rights. If you're bringing your children into the business, you can limit your capital value to say, actually, you as the founding member of the company, you can't participate in the future capital growth, which is a great way to plan for inheritance tax. The growth shares might go to your children so that it falls into their estate when you build value through property. There's loads of different ways of doing this. But don't just go ahead and set up a normal limited company if you are looking at growing a large property portfolio, because it will cost you more in tax in the long run. And then, of course, another fantastic way to structure a limited company is part of a group structure. So if you've already got a successful trading business that's generating cash flow and you want to start utilising this to invest in property and everything else, that's where that group structure can come into play. So what you do here is you usually do a share-for-share exchange, put a holding company in that you own now. You own the shares in the holding company. You've got your trading business underneath as a subsidiary, and then you'll have your new property investment company here. And what that allows you to do is take dividends up to the holding company, bring them out of the business so that they're out of harm's way, any creditors, any legal action, and then you can safely put that money to work in the property investment company and grow it completely aside from your trading business. A lot of people can often get bad advice from their accountants who aren't familiar with the group structures and how to optimize the tax position. We've seen it before where potential clients have come to us and my accountants advised me just to take the money out of my trading company personally as a dividend and then put it into a property investment company. That's absolutely not the way to do it, because you will pay a lot of income tax taking those dividends out of your limited company when you don't actually need to do that. So now you know the best structure and you've got your limited company set up. How do you actually go about running your limited company from an accounts and tax point of view? So the first thing to mention, especially if you are new in property, this is your first limited company, you need to be aware of the deadlines that are going to be involved when it comes to actually doing your accounts and corporation tax returns. And my best advice here is stay on top of these deadlines. Sometimes we have kind of new clients come to us, they forgot about deadlines, they've got thousands of pounds in fines just because they're new to this and they didn't know the deadlines that were involved. So make sure you take a note of these if this is your first business. So when you set up a limited company, it is a separate legal entity, and that limited company needs to produce accounts to Companies House. The month that you set your company up in say for instance you do it the 15th of December, up until the end of the month, so it always rolls forward to the 31st of December, then 12 months after that will be your year end. So if you set it up now, kind of 10th of December 2024, your company's first financial year will be until 2025, the 31st of December then. And then from that date, you've got 9 months basically to put your limited company accounts to Companies House. And you've also got 9 months to pay your corporation tax, but usually the 9-month window is what all accountants work by. So 12 months from when you set the company up, and then 9 months after that on an ongoing basis to actually prepare the accounts, file the confirmation statement, which is needed as well, and get that tax return into HMRC. That's the kind of admin stuff. You obviously need an accountant to deal with that, but make sure you take a note of those deadlines so that you're on top of it and you don't get any nasty fines. As a limited company, what taxes do you actually pay? So the first tax that you pay as a limited company is corporation tax, and this is charged on your profits. So as a property investment business, if you have £100,000 worth of rental income, you deduct all of your mortgage interest, your management agent's fees and everything else, and you've got £40,000 of profits. Assuming you've got no other businesses, because if you do, the small profits threshold, which is £50,000, will be reduced by the number of associated companies you've got. But if this is your only limited company, on that £40,000, you'll pay 19% corporation tax. And that small profits threshold is up to £50,000. And after that rate, the profits then begin to be taxed at 26.5% up until £250,000. And as I mentioned earlier, this tax is due 9 months and 1 day after the company's year end. Once you've calculated the amount of tax that you've got to pay, then you can look at extracting funds from the company. So always remember that when it comes to taking up dividends from your limited company, these have to be paid post-tax. So whatever your profit is, less the corporation tax, whatever you've got left in the bank, you can then usually take out as a dividend from the business. What expenses can you claim in your property investment business? Well, the good news here is that it's very, very wide ranging. So anything that you do genuinely incur to grow your business, you can claim networking events, property training, of course, the general day-to-day expenses, working from home if you've got an office, branded clothing, business cards, mortgage interest, whatever it might be. If there's a genuine reason for you incurring that expense, you can absolutely claim it. Use the company card, don't use personal funds. It's coming off of your profit and reducing the amount of tax you pay. And then one that a lot of people often forget is, if you're going out on viewings all the time, you're going up and down the country, a lot of people invest far away from home. So if you are travelling to Manchester or Liverpool to strictly look at properties, then actually you can claim all of your travel costs there, any accommodation, potential food and drink the night after as well, if you are staying there for a couple of days on business. This is where you do need to keep a good detailed log of, okay, these are the properties I viewed. You can see the HMRC, you could evidence to HMRC that you did actually do a full day's worth of viewings and it was strictly a business trip. If, of course, you go out for a nice dinner in the evening and have some personal downtime, that's fine because it's outside of reasonable working hours. As long as the next day you've got another full day lined up of business-related activities. What's the best way of actually putting money into your limited company? So, of course, you need to put the deposits, the 25%, the legal fees, the stamp duty, that needs to be going into the company bank account in order for you to actually be able to buy a property. Usually, the way most people do this is through a director's loan. So currently you might have the £50,000, whatever it might be, sitting in your personal bank account. As soon as you've got the limited company and the limited company bank account set up, you'll simply transfer this into the company, mark it as a director's loan account so it's clear for your accountant to see exactly what this transfer is. And then that now sits on the company balance sheet as an IOU. Effectively, the company owes you personally £50,000 and you can take that out tax-free at any time. You could charge interest on this, which can be a great way to reduce your tax bill and take more money out tax efficiently from your limited company. And that's just typically how it's done. And of course, any other expenses that you incur personally, but on behalf of the business, they can be added to this director's loan account as well. So the mileage cost, the travel costs, any personal expenditure that, if you start using your laptop for the business, you could transfer that in to your company at the current market value, and that would increase that director's loan account and just give you a larger sum to take out later on completely tax-free. Another way of funding the business is through intercompany loans. So if you've not got the group structure, or if you do have the group structure, you can potentially loan the money down from your holding company to the property investment company, or even without the group structure, you can do it from your trading business to your property investment business. But it's best to avoid doing it this way simply because over time, if you continually make large transactions, you've got a large debt owed from the trading business to the property investment business. Then actually, if you try to exit from that business, you have any kind of legal troubles, then that can actually cause problems later on down the line because you've got a large balance sitting on that balance sheet. When it's best to avoid that, just to keep your property business completely separate and of course secure. How do you go about taking money out from your limited company? So, of course, now the business is in operation, you've got properties, you've got profits. How do you actually go about extracting money? So, for most people, a salary is still tax efficient to take from your limited company. From next year, the secondary national insurance threshold has dropped down to £5,000. So, if you're the only director on the payroll, no employees, you will not get the employment allowance, which means that it'll be a little bit more employers' national insurance to pay at 15% on the salary you take. But because 15% national insurance is still less than the 19% corporation tax, you actually still do save money by taking out the full £12,570 salary. If you're either a basic rate taxpayer or you have no other income at all, it definitely makes sense to take that through. If you don't want the hassle of paying the national insurance every quarter, take the £5,000 salary, and that will mean that you don't have to make any payments each quarter for the PAYE, the national insurance that's been deducted. Once you've taken the salary out, interest can also be a great way to take money out of the company simply because it comes off of your profits. When you've got a director's loan account, you can charge a market value interest rate on that loan. That is then deductible against the profits in the business, and you can usually receive this pre-tax efficiently. As a basic rate taxpayer, you've got £1,000 a year personal savings allowance, and then depending on your other income as well, if you've got up to £5,000 worth of interest income, and that's your first taxable income over and above the personal allowance, that can also benefit from the 0% savings nil rate band as well. So there's quite a few different mechanisms to get interest out tax-free, and even then, because there's no national insurance on interest income, when you take that out, you only ever pay income tax on that income. So it's 20% if you're a basic rate taxpayer, 40% for a higher rate taxpayer. So actually, if you've got a large director's own account, it can make sense to charge the interest because it comes off of the profits, unlike dividends. So with dividends, that's usually the last way to take money out of the company, simply because you pay corporation tax first, and then whatever's left you'll take out, and then you pay income tax on again. So you're being taxed twice on money when it comes out as a dividend, whereas with salary, because it's tax deductible in the company, same as the interest, you only actually ever pay tax once. But with dividends, you've got a £500 a year tax-free allowance. Then anything over and above this will just be added up to your other income, and if you're a basic rate taxpayer, taxed at 8.75% or 33.75% for a higher rate taxpayer. And it's important to know, even if you don't fully take out the dividends, but if you are a lower rate taxpayer at the minute and you do plan to become a higher rate taxpayer in the future, it can be worth actually taking dividends out, taking that cash out and then loaning it back in personally, just to increase that director's loan account as much as possible so you can take more out tax-free later on. Kind of locking in these low tax rates is what we suggest to clients. And there we have it, guys. Everything you need to know from a tax and accounts point of view about investing in UK property. Hope you find this video useful. Please do give it a thumbs up and smash that subscribe button. Until next week, bye for now.